In this video, I'm going to show how to record the journal entry to reduce the inventory to market value under either the cost of goods sold method or the loss method. With that, let's get started.
So the company uses LIFO inventory costing. At January 1st, 2020, inventory was $334,640 at both cost and market value. Okay, they're the same. Now, at the end of the year, inventory was $425,820 at cost and $400,440 at market. So, what is the journal entry to reduce inventory to market? Note, this is a LIFO inventory. So, under LIFO, you can use market as opposed to using lower cost or net realizable value. So, step one, we are going to debit. So under cost of goods sold method, well, costs of goods sold, debit cost of goods sold for the difference between the two. So that equals $425,820 minus $440. $25,380 is my debit or my increase in cost of goods sold because of this valuation problem. And now I'm going to credit my allowance to reduce inventory to market, or whatever the account title is, but it needs to be my loss. So, and I want that loss to be the $25,380. So there is my journal entry to record the loss using the cost of goods sold method. Now, if I wanted to instead do the loss method, my credit is going to stay the same, but now my debit is actually going to be to loss due to market decline or some equivalent, and that is going to be the same amount. The amount's not going to change. Regardless, I have this loss. It's just a matter of where does it end up on the income statement. Does it end up as cost of goods sold, which reduces my gross profit for the company? Or does it get stuffed into a loss amount that gets reported in, say, other gains and losses on the bottom of my income statement? So that's really the only question that's going on here. Either way, we have a contra asset, which is reducing the inventory to, in this case, to market. For whatever inventory we had at the beginning of the year, the market value and the costs were the same. Our inventory, we bought some, we sold some, a bunch changed over the course of the year, as well as the environment in general. At the end of the year, the inventory that we had on hand at the end of the year, the market price was lower than the cost of that inventory.
I did want to highlight, so at the beginning of the year, the market value and the cost basis of the inventory were the same. However, at the end of the year, the market value of the inventory was less than the cost basis, and that's why we have the write-down. Now, the change between it being at market at the beginning of the year and end of the year is not really pertinent to our current conversation, because the inventory that we had at the beginning of the year is different inventory than we had at the end of the year. So at the beginning of the year, there's no reduction in the value of the inventory. At the end of the year, there is, because the cost of the inventory on hand at the end of the year was more than the market value of inventory. So we needed to write the inventory down, in this case, to record it at the lower of cost or market. That wraps up our discussion of how to record the journal entries for the reduction in market value of inventory when we're recording inventory at the lower of cost or market under either the cost of goods sold method or the loss method. So with that, have a great day. God bless.